Dan Ives, the global head of tech research at Wedbush, just made a bold statement on CNBC saying that Wall Street is underestimating Nvidia's growth. He's calling Nvidia the core of the AI revolution, saying China growth alone could hit 50%, and even predicting tech stocks will rally further into year-end. And when the man in the black leather jacket, Jensen Huang, talks, Ives says, you better listen. In today's video, I'm going to show you the clip of Dan Ives on CNBC, and then I'll give you my own detailed reaction and breakdown of what he said. After that, I'll dive into my in-depth analysis of what I believe is the best growth stock to buy right now, even if you've got only $1,000 to invest. So, if you only watch one investing video today, make sure it's this one. Stick around all the way to the end. Before we roll the clip, hit that like button. Let's run this one up to 1,000 likes. Share this video, drop your thoughts in the comments, and make sure you subscribe so you don't miss the next big investing update. Alright, let's hear what Dan Ives had to say.
All right, I want to start with the same question I asked our 𝗗𝗘𝗧 earlier. We have a lot of notable voices out here that believe that this is an overreaction to the stock, and the stock actually has the potential to go positive throughout the trading day. What was your take on the quarter, and do you think the downside move was an overreaction?
Yeah, Frank, I think the stock's up today. And to my point, I think it's really when you look at the guidance, and that's not even factoring in China. I mean, China could be an incremental $2-5 billion. And they did for the first time. Jensen talked about maybe giving a little sneak peek. China revenue could be 50% growth. I mean, that was just eye-popping. And I think as investors digest this is a stock that's up, and I think a further validation for the AI revolution as well as Nvidia.
All right. The miss was on data center revenue. It was a very slight miss in all fairness, but it was a miss. How should we read that? I know it doesn't include any China guidance, but the fact that it wasn't a blowout quarter for data center when we continue to see these CapEx investments by the hyperscalers and other companies.
Look, Frank, I view it as noise because in my view, you got to look at the story with China. You can't look at it excluding China. And I think when you look at this quarter, you look at next quarter, and what I think the most important thing Jensen talked about is the 50 billion, the 50% growth, when you're thinking about what China could be. I mean, you put it all together, this is a story that is actually just going into acceleration mode. So there's nothing here that makes me less bullish. I mean, I actually think you're more bullish as a validation point in terms of what you're seeing without China.
All right, Dan, we know you're one of the biggest bulls when it comes to tech on the street, but there are some other factors here. First, we had a report yesterday that China's trying to triple its chip output. Our 𝗗𝗘𝗧 mentioned there was a Chinese chip company that saw its profits increase by 4,000%. So there seems to be some rising domestic competition, and the Chinese have also voiced some concerns about security issues with these H20 chips, and also just, I guess, some hurt feelings about some things that the Commerce Secretary had. I mean, aren't these some real issues for this company's ability to sell in China and grow those revenues that they've forecasted, but aren't there some real headwinds along the way?
Yeah, look, no doubt. I mean, Jensen's going to have to play that 10% politician, 90% CEO, the back and forth between DC and Beijing. Look, the biggest chip on this poker table is Nvidia. But it comes down to in China, they want Nvidia chips. It's the only, to me, not just game in town, it is the chip fueling the AI revolution. And I think as you start to see this play out, you're going to see that China market continue to expand massively because they're years ahead relative to any other competitor, including Huawei. And I think that is just the reality as this all plays out. There's going to be a lot of noise. But at the end of the day, the top of that mountain is the godfather of AI, Jensen Nvidia.
All right, let's talk about investing right now. It's hard to call this buying the dip because this stock's run up about 35% since its last earnings, and it's only pulled back right now about 1.75%. But when it comes to Nvidia or even the NASDAQ, again, hard to say buy the dip because the NASDAQ futures are just very slightly in the red. Do you see this as a buying opportunity? And if you thought that the stock was frothy before earnings, isn't it still basically kind of frothy?
Yeah, I mean, to that last point, I actually think it's cheap relative to where I think numbers are going. I think Street's underestimating numbers 25-30% next few years, especially when you factor in China, what ultimately this could look at. And in my view, you combine this with what we saw from the hyperscalers and what we're seeing in terms of overall earnings, what you've seen from Snow, what you've seen from MongoDB, you combine that all, of course, Palantir. The story is playing out. The next phase of AI revolution is playing out. And that's bullish not just for Nvidia, but for tech. And I think tech stocks rally more into year end.
All right, Dan, I'm going to ask you a tough question, at least for you. Is there any part of the tech landscape that you're seeing weakness in following this report? Like we see CoreWeave up, we see some other stocks just fractionally lower. Is there any part of the AI tech trade that you have questions about following this report related to the data center numbers or anything else?
Look, it's not necessarily on that side, but like when you look at Adobe and you look at software, I mean, this is just further shows like what could be eating their lunch, right? That it's putting more software on the defensive. Salesforce, Adobe, I think Salesforce will actually be able to come out of this strong. But look, I think this just shows this AI arms race is not slowing down. It's accelerating. And there's one person that when he talks, you listen. He's wearing a black leather jacket. His name's Jensen.
The interview started with the host asking if the market's reaction to Nvidia's earnings was an overreaction. A lot of people on Wall Street felt that the dip we saw in Nvidia's stock was exaggerated, especially considering the company's long-term prospects. Dan Ives jumped right in by saying he believes the stock is up for a reason, and he pointed directly to guidance. That's important. Guidance is what the company projects about its future performance, and Nvidia's guidance included something that really caught investors' attention: China. For the first time, Jensen Huang, Nvidia's CEO, gave a little sneak peek at how big China could be for them. He hinted at 50% revenue growth in that region. That's massive. According to Ives, that number alone could translate into an incremental $25 billion opportunity. So, while some investors focused on the downside noise from data center revenue being a touch weaker, Ives is saying, zoom out. The China story makes the bigger picture way more bullish. Now, the host pressed him on the fact that Nvidia slightly missed expectations on data center revenue. Normally that would matter a lot because Nvidia's data center business is the backbone of AI infrastructure. But Dan Ives waved it off, calling it noise. His reasoning? You can't evaluate Nvidia without factoring China into the equation. When you do, the so-called miss becomes less meaningful compared to the potential acceleration coming next quarter and beyond. His tone here is important. He's saying this isn't a slowdown, it's just a temporary distraction. In his words, the story is moving into acceleration mode. That's analysts speak for, buckle up. Things could get even bigger from here. But then, the interviewer pushed back, pointing out something serious. China is ramping up domestic chip production. Some Chinese chip makers are showing huge profit growth, and there are political tensions between Washington and Beijing. Couldn't that threaten Nvidia's ability to grow in China? Dan Ives didn't dismiss those risks, but his take was strategic. He said Nvidia's CEO Jensen Huang needs to be 10% politician, 90% CEO when navigating these geopolitical waters. Meaning, he has to play the diplomacy game with both Washington and Beijing, but Ives's bigger point was that China wants Nvidia chips. In his view, despite competition from Huawei and others, Nvidia is still years ahead technologically. And because their chips are literally fueling the AI revolution, demand will be insatiable. He even crowned Jensen Huang as the godfather of AI. That's how central he believes Nvidia is to this moment in tech history. Next came the big investor question. Is this a buying opportunity, or is Nvidia already too expensive? Dan Ives didn't hesitate. He actually called it cheap relative to where earnings are headed. He believes Wall Street is still underestimating Nvidia's growth. He threw out numbers like 25% to 30% growth over the next few years, especially if you layer in China. But what really stood out here is how he connected Nvidia's performance to the broader AI ecosystem. He name-dropped hyperscalers like Amazon and Microsoft, along with software players like Snowflake, MongoDB, and Palantir. His point was that Nvidia is the engine, and all these companies are the cars riding on that engine. The next phase of the AI revolution, as he put it, is already unfolding. And that doesn't just lift Nvidia, it lifts the entire tech sector. He even predicted that tech stocks overall could rally into the end of the year. Finally, the interviewer asked him if there were any parts of the tech sector showing weakness in light of Nvidia's dominance. Dan Ives pointed towards software companies, Adobe, Salesforce, and others, saying that the AI boom could eat their lunch. Basically, as AI reshapes industries, some traditional software companies risk falling behind. He did say Salesforce might adapt well, but overall his message was clear. This AI arms race isn't slowing down, it's accelerating, and those who don't evolve quickly could get left behind. So what's the big takeaway from Dan Ives' interview? It's this. Nvidia remains at the center of the AI revolution, and while there will be noise, whether it's a small revenue miss or geopolitical headwinds with China, the bigger story is one of growth and acceleration. Ives is more bullish than ever, not just on Nvidia, but on the entire tech landscape that depends on its chips. He sees this as validation that the AI revolution is only getting started, and Nvidia is years ahead of its rivals. For investors, that means opportunities are still out there, though not without risks. For the broader tech industry, it's a reminder that we're at the start of a new chapter, where the winners will be those who can harness AI most effectively. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's dive into the best growth stock to buy with $1,000. The company in question is Chewy, ticker symbol CHWY, the go-to online destination for pet parents. Chewy isn't just an e-commerce retailer, it's built on competitive pricing, lightning-fast delivery, and legendary customer service. From handwritten cards to flowers for grieving pet owners, Chewy forges deep emotional connections. This has created a fiercely loyal customer base and made Chewy the dominant force in online pet retail. Its logistics network ensures fast, reliable delivery of essentials like food and medicine. Chewy is a one-stop shop, combining online convenience with the personal touch of a neighborhood store. It's not just about pet supplies, it's about pet happiness. Let's dig into why Chewy is a phenomenal stock for today and tomorrow. Chewy's business model is brilliantly simple. A massive online superstore for pet products, sourcing from over 2,000 brands. Its scale means better prices and endless selection, drawing customers in. But it's the convenience and service that keep them coming back. Chewy's state-of-the-art fulfillment centers enable fast, reliable shipping, often in just a day or two. The user-friendly website and app make shopping seamless, eliminating the hassles of traditional retail. What truly sets Chewy apart is its 24/7 customer service, empowering staff to delight shoppers and build trust. This human touch creates brand evangelists and loyalty that's hard to replicate. Chewy's data-driven approach personalizes recommendations and streamlines inventory, especially through its auto-ship subscription. The result? A fusion of scale, logistics, service, and technology that powers Chewy's explosive growth. Next, let's see why this business thrives even in tough times. Chewy operates in the booming, recession-resistant pet industry, where spending is non-discretionary. Even in downturns, pet parents prioritize their pets' needs over almost everything else. During the Great Recession, pet spending actually increased. U.S. pet spending has soared from $92 billion in 2018 to an estimated $151 billion in 2024, nearly 9% annual growth. As the leading online player, Chewy is perfectly positioned to capture this expanding market. The pandemic accelerated online adoption, especially among millennials and Gen Z. Chewy's active customer base has swelled to over 20 million, proving its ability to attract and retain new pet owners. This isn't just a stable market, it's a growth engine. Owning Chewy means investing in a business that thrives in any economy. Now let's talk about how you can unlock your own investing potential. Chewy's AutoShip program is its game changer, a subscription service for recurring deliveries of essentials like food and medication. With just a few taps on the app, pet owners can schedule automatic shipments, ensuring they never run out of the products their pets need most. This seamless experience removes the hassle of last-minute shopping trips and gives customers peace of mind, knowing their furry friends are always taken care of. Customers get convenience and savings. Chewy gets predictable, recurring revenue. AutoShip subscribers often receive exclusive discounts, making it even more attractive to sign up. For busy families and devoted pet parents, this service is a true lifesaver, saving both time and money while building trust in the Chewy brand. In Q1 2025, AutoShip sales surged nearly 15% year-over-year to $2.60 billion, now over 82% of total revenue. This remarkable growth highlights just how central AutoShip has become to Chewy's business model, driving both top-line results and long-term sustainability. This high percentage of recurring sales gives Chewy incredible visibility and stability. With so much revenue locked in through subscriptions, Chewy can plan ahead, invest in new initiatives, and weather economic ups and downs with greater confidence than many competitors. AutoShip customers stick around and spend more, making the business more predictable and efficient. These loyal shoppers are less likely to switch to other retailers, and their consistent orders help Chewy optimize inventory and logistics. The subscription model creates a sticky ecosystem. Once set up, customers rarely switch. The convenience and reliability of AutoShip make it a habit, turning Chewy into a go-to destination for all things pet-related. AutoShip is also a gateway to deeper relationships, letting Chewy introduce new products and services. With every delivery, Chewy can surprise customers with samples, personalized recommendations, and special offers, further strengthening loyalty. It's not just a sales channel, it's a loyalty machine that locks in customers for life. The emotional connection built through reliable service and thoughtful touches keeps pet owners coming back again and again. This is the engine behind Chewy's long-term value and a key reason the stock is so compelling. Investors recognize the power of recurring revenue and the potential for continued growth as more pet owners join the AutoShip program. Next, let's look at Chewy's expansion and what it means for investors. As the company grows its reach and deepens its customer relationships, the future looks brighter than ever for Chewy and its loyal shareholders. Critics once doubted Chewy's profitability, but those days are over. Chewy is now consistently profitable, with Q1 2025 operating income up 19% year-over-year. Margins are expanding, and as Chewy scales, there's room for even more growth. With a stable U.S. business, Chewy is now expanding internationally, starting with Canada. The Canadian market is large and underserved, giving Chewy a clear path to replicate its U.S. success. This playbook can be used for future expansion into Europe, Asia, and beyond. Chewy is also moving into high-margin pet healthcare, pharmacy, insurance, and even vet clinics. These services deepen customer relationships and boost profitability. By becoming a trusted partner in pet health, Chewy is building an ecosystem that's hard to leave. Expansion into healthcare is a powerful catalyst for future growth. Let's see how this translates to stock performance and valuation. Chewy's stock is on a tear, up 18% year-to-date, handily beating the S&P 500's 10% gain over the same period. This impressive run has caught the attention of both Wall Street analysts and everyday investors, who are now taking a closer look at what's driving Chewy's momentum. This outperformance signals the market's recognition of Chewy's strong business fundamentals, innovative approach, and compelling growth story. Investors are increasingly confident that Chewy's strategy is working and that the company is well positioned to capture even more market share in the booming pet care industry. Over the past decade, growth stocks like Chewy have consistently outpaced value stocks by a wide margin, rewarding those who bet on innovation and expansion. Chewy's ability to deliver strong revenue growth, expand its customer base, and adapt to changing consumer trends has set it apart from more traditional, slower-growing companies. Chewy's leadership team has demonstrated vision and agility, capitalizing on strong industry tailwinds and driving expanding profitability. Their focus on customer experience, technology, and operational efficiency has made Chewy a standout performer and a potential long-term winner in the e-commerce space. Of course, some investors worry about Chewy's high price-to-earnings ratio, which is well above the market average, but for a company with Chewy's growth prospects, a premium valuation is often justified. Investors are willing to pay more for a business that's growing faster and has a clear path to future profitability. The market is pricing in Chewy's rapid earnings growth and its dominant position in the online pet retail sector. As Chewy continues to innovate and expand, expectations for future earnings remain high, supporting its elevated valuation. Remember, you don't get a Ferrari for the price of a Ford. Quality growth companies like Chewy deserve a premium. Investors understand that paying up for excellence can lead to outsized returns over time, especially when the company is firing on all cylinders. As Chewy expands into new markets and launches additional services, today's valuation could look like a bargain in hindsight. The company's relentless focus on innovation and customer satisfaction positions it for continued success and future growth. Chewy currently holds a market cap of $16.97 billion. The company has an earnings per share of 92 cents and a price-to-earnings ratio of 44.59. For 2024, it generated $11.86 billion in revenue and posted a net income of $392.74 million. The stock is trading at $41.02, which is nearly 54% below its fair value estimate of $63.14, giving investors potential upside. There's been a wave of positive sentiment around Chewy lately. Several brokerage firms have issued favorable recommendations, reinforcing the idea that this company has plenty of room to grow. Analysts believe this bullish outlook could fuel stronger investor confidence. All eyes are also on September 10, 2025, when Chewy reports its fiscal second quarter results. Many expect the numbers to reflect the company's investments in technology upgrades and growing customer engagement. Chewy has also been expanding its product offerings through strategic partnerships. A recent highlight was the addition of Roborock's robotic vacuums to its platform, signaling Chewy's focus on enhancing customer experience while diversifying beyond its traditional base. Moves like this not only strengthen its brand, but also broaden its appeal in an increasingly competitive retail landscape. Despite wider market volatility, Chewy has shown resilience. Its diversified approach, particularly through segments like auto ship and vet care, has been instrumental in driving consistent growth and building a loyal customer base. This ability to adapt while innovating gives Chewy a strong position among peers in the pet care industry. Overall, Chewy has been demonstrating notable strength in the market, with analyst support, new product integrations, and upcoming financial results that could act as a catalyst. The optimism from both investors and analysts highlights its potential as a reliable growth stock, making Chewy a company worth watching closely in the months ahead. The smart money isn't scared by the PE ratio, it's excited by the growth ahead. Institutional investors and hedge funds are betting that Chewy's best days are still to come, and they're positioning themselves to benefit from the company's ongoing expansion. Now, let's talk about how you can become a master investor and take advantage of opportunities like Chewy's remarkable growth story. We've covered Chewy's recession-proof model, auto ship engine, and expansion opportunities. But finding one great stock is just the beginning. Real wealth comes from learning to spot these opportunities yourself. That's why we've relaunched our Value Stocks Investing Master Course, your toolkit for real-world investing success. For deeper analysis, join our Stocks Galore Patreon for exclusive tips and direct access to our team. It's the perfect place to connect with serious investors and uncover the next market-beating stocks. Chewy is a fantastic addition to any growth portfolio. Invest in what you understand and believe in for the long term. What new services do you think Chewy could launch to strengthen its ecosystem? Share your ideas in the comments and don't forget to like and subscribe for more deep dives.